But let's shift focus and let's talk about what's happening amongst banks. It's important to take cognizance given the kind of spike that one has seen in retail delinquencies. Banks have reported higher retail slippages in the first quarter. Auto loans and gold loans are the ones wherein you're seeing maximum pressure actually come in, and that's where the most pain is being felt. So let's take cognizance of what's happening within the sector. How long are the retail delinquencies and the NPA pressures likely to persist? We have with us Tamal Bandyopadhyay, author and senior journalist, and we also have Ajay Srinivasan, director at CRISIL Research, joining in on the show right now. Gentlemen, good morning. Good to have you on the show. Tamal, if I could start the discussion with you. We were just chatting with the market expert a while back, and he said that he would have been surprised had banks not reported retail delinquencies in the quarter gone by. Would you say that this was a one-off quarter because of the impact of the second wave, or do you think this kind of pressure is likely to persist in retail-ended banks?
No, I think it's because of the externalities, solely because of the second wave. And if you just go back to history, since 2016 financial year, when Reserve Bank of India started this so-called asset quality review, when the bank started bearing the skeletons from their covered NPAs gone up. So the past 5 or 6 years, the entire banking system had been on a sort of rebalancing their portfolios. Till such time, the smaller the banks, the bigger the corporate lendings are there. But certainly, post this Reserve Bank of India action and finding that there are too many bad loans in the corporate segment, almost every bank started rebalancing, and then essentially we call it rebalancing or de-risking. What does it mean? That bringing down the corporate loan portion and getting into retail in a big way. I mean, look at, for instance, IDBI Bank. Where was IDBI Bank 6 years back, and where is it now? Until recently, you will find that IDBI Bank's retail portfolio is pretty good. I mean, I will not call it immaculate, but as good as it could be. So that has been the case. That's pointer one. Pointer two is this. Again, if you look at the 5-year credit growth, it's single digit, more or less credit growth, but it was driven primarily by the retail loans. So one end is that one part of it is the de-risking or the rebalancing portfolio, and second part is that's the only place where they could grow. And everything came to a sort of I will not call it a grinding halt, but had the problem in the first round last year. They could overcome because of the multiple efforts by both the regulator as well as the finance ministry, liquidity and restructuring and everything else. But they were probably not prepared for the second wave. Now, I'll just quickly cut it short and take the questions later. At this point of time in Indian banking system, I see 3 types of banks. One are risk, and I am not going to name. You can figure out from the numbers, from their earnings. One is the risk averse. They have stopped growing, and probably, I mean, they just don't want to meddle in this water at this point of time. Second is risk manager. They are growing, but not as much as historically they have been. I'm talking about retail loans. And third is sort of adventurous. This set of banks, very few of them misread last year, the first wave. They thought that's the end of it, and they grew much more than the industry average. So probably the strategy was, we'll give more money, and including those who are on the verge of default, and that will help them to come back from this 30-day or 60-day delinquency, pay us back, and our balance sheet also would grow. But that was a short-term gain, probably this few banks had done, and they did not anticipate what would have happened in the second wave. And second wave, even though we did not have any nationwide lockdown, but all over, all over the place, there are sectorally, there are a lot of restrictions, lot of containment zones everywhere. That's one part of it. So the supply chain, the supply side issues cropped up, supply chain management gone for a toss because of that. And also it happened from urban India the playing field of COVID shifted to rural India. And which is why you find also the problem across, not only for the banks, even MFIs. So to cut a long story short, I think this was for some of the banks it was misreading that they did not read that the second wave would come and hit so hard. But is it here for going to stay? And that will be the case for the Indian banking. I think we need to wait and watch, because the solution of the problem not lies, apart from risk management or risk averseness, also it's a health related issue. So how fast we get back to normal life, how fast the business starts, shops and establishments opening the door, and essentially how fast we get the vaccination done.
Indeed. Ajay, if I could get you in here, I mean, it seems like this is just a one-off case because of, the second wave impact that one saw in banks. But should banks now turn slightly more conservative towards retail loans just to try and protect themselves first?
I think most banks and lenders have already turned conservative. If you look at the incremental loans which they have underwritten, right, post-COVID, and talking about the first wave of COVID, there have been restrictions in terms of sectors they are lending to. There are restrictions they have put in place in terms of tenure and in terms of the bureau thresholds as well. So most lenders have already turned a little conservative, and that is reflected in the kind of numbers which you see in terms of retail loan growth at a systemic level. Also, I would say that today most lenders are also adopting a very regional and focused strategy. So they are going more aggressive in regions where they believe that things are a little better. So today you see that there is far more method in the way they are doing things. But yes, I think one cannot shy away from the impact of the first wave and the second wave. And a lot of businesses, a lot of individuals have been impacted. If you look at the numbers, partly, especially on the MSME side, right, the emergency credit line scheme which the government came out with, it possibly has helped really control the situation a little bit on the MSME side. And you will only know that how those assets are going to play out over a period of time. But the fact of the matter is that it was like a temporary liquidity which was made available to the MSMEs because of the emergency credit line scheme. And bear in mind that as an economy, we are still below fiscal 20 levels. And a lot of the individuals who had taken loans in pre-COVID, they would have taken with a very different assumption on their income. And a lot of industries have been impacted because of the COVID. And therefore, it's not surprising to see that asset quality has deteriorated. If I look at, for example, the auto segment, I think nobody could have anticipated that diesel prices, for example, will shoot up the way they are shot up, right? And this has had some kind of an impact on, say, commercial vehicles, for example. Now we are seeing a slight improvement because of demand coming back. And fingers crossed, if the festive season turns out to be good, then you may see the situation actually improve quite a bit in that segment as well. So clearly, I think it's partly the second wave. It's partly also because of the kind of assumptions which banks and lenders had made pre-COVID, and even during the first wave, like Tamal rightly pointed out, on the recovery. Also, I think incrementally, most of the banks and lenders, like I stated earlier, have got more cautious. And possibly this caution will persist for quite some time until the signals are very clear that we are not going to have a third wave or a fourth wave.
Okay. Tamalda, if I look at the comments, the forward-looking comments which have come from HDFC Bank, Axis, even for that matter ICICI Bank, while they are acknowledging that retail book has remained under stress, alongside they are also saying that, look, June, July things have become normal. Should we take that with a pinch of salt, or that is a realistic assessment?
Well, see, I can't judge because they are sitting from their chair. I mean, sitting in their from their part, they are looking at things. But when I look at the industry and my interaction with across banks, I find that it's too early to to conclude that this is what the worst is behind us. because there is a structural difference between what happened last time and now. We had this 3 trillion government guaranteed scheme, and as you have seen that continuously get evolved and changed, the model changed, because there are not too many takers initially. And right now, I guess most of the money has already been disbursed. Now, those guys, they were now coming up, the bankers thought and they themselves thought. Second wave hit them hard because structurally, again, I said the second wave is very different because you have sporadic containment zone, you have sporadic lockdowns, supply chain management completely breaking down, and then rural India. So many of these guys, particularly in the MSME and SME segments, and if the bankers are talking about auto loans and home loan, that's a separate story altogether. But if you're talking about MSME, SME, and the small trader thing in semi-urban, even in urban areas, many of them actually capital because they have eaten up their capital. It's not the bank loan. It's not the debt. They need even capital. So situation is not as simple as we are looking at it. However, there is a difference in the segment. For instance, you see that there's a huge growth, and suddenly India discovered gold loan as a retail product, which was something unheard of. I mean, it was a domain of very few NBFCs, particularly in the southern India, because it was a taboo that will not take out our family gold. But now, if you see, there has been study done. Those districts where the death rate is higher than the average, or more people died because of COVID, the gold loan portfolio has grown much more than the other districts. And also, there is a flight of deposits in those districts. So gold loan is a sort of compulsion they have done. And if you ask any banker, the typically people take gold loan for 1 year, but then it's not for productive purposes, it is for emergency money. And they also try to come back to the bank's door and pay off and take the loan back, take the gold back faster. So this is fully secured loan. There is a lot of margin and there is no capital requirement, if I'm not mistaken, for the gold loan. That's a separate story. But if you look at the SMEs and MSMEs and the small traders, urban, semi-urban and rural India, things are definitely, it will take time to look up. Because as I said, many of them, more than debt, they need capital. And if you look at particularly the MFI segment or the small finance banks and some of the banks, again, I'm not going to name any particular thing and all, which are banking heavily on that segment, they are more affected than the banks that which you have mentioned. I think in my category, these 3 banks which you mentioned, they are not the adventurous type. They are either risk averse or good risk managers. But there are adventurous types. They have to pay the price for it, and because the solution is a medical, it's a health related issue, and the solution is vaccination and return to normalcy as far as business is concerned. So bankers can't do much about it. Will there be third wave? If there is nothing, then yes, things will look up. And what these bankers are based saying, it will be proved. But if it's their third wave, I think we have to wait for that.
All right, gentlemen, really appreciate it, Tamal. It's always a pleasure to interact with you. I always look forward to our engaging conversations and learning a lot from you. Let's take a break.